What's going on, my fellow wealth creators? Matty Ice here. In this video, we're going to do a comparison of dividend paying whole life insurance and indexed universal life insurance and talk about the major differences between the two so that you have the information you need, the facts, in order to make an informed decision about which one is best for your specific situation, your specific goals, or maybe by the end of the video, you don't want anything to do with either one of them, and that's totally fine. It just comes down to what it is you're trying to accomplish, what's going to be a good fit for you. The reason I want to do this video is because there's a lot of really bad information out there about both dividend paying whole life insurance and index universal life insurance. And this is important for me to do as well because I almost purchased an IUL without having all the information, and it would have been a complete disaster. Once I understood how IUL actually worked, I wanted nothing to do with it. Now, that does not mean that you would come to the same conclusion. Maybe when you get to the point where you understand index universal life insurance, the risks involved, all the things that could change, all the things that could potentially go wrong, it might still be a good fit for you, and that is totally fine. But my problem is with how many people are putting their hard-earned money into this product without knowing the risks involved. They don't know what they're actually putting their money into, and it's IUL is very, very, very overhyped. It's just incredible. Upside potential, downside protection. You can't lose money in an IUL. You're going to get all this tax-free retirement income, blah, 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 blah. It sounds really good, looks really good on paper, but how does this thing actually work? And how does it compare to dividend paying whole life insurance? Because that's what I landed on. Once I learned how dividend paying whole life insurance actually works, it was a no-brainer. I was like, this is actually what I was looking for that I thought I was going to get with IUL, but it's dividend paying whole life insurance. So let's get into it. This might be a little bit of a longer video because I have a lot of points that I want to get through here, but I'll get through them as quick as possible. I just want to be as thorough as possible too, though, so that you get the information. All right. First, let's talk about level cost of insurance versus increasing cost of insurance in these contracts. Okay. So with dividend paying whole life insurance, you have level cost of insurance. It's guaranteed to never increase. Your premiums never increase. Everything is guaranteed. And what happens is, this is where you hear about dividend paying whole life insurance being more expensive in the beginning than an IUL. IUL is a lot cheaper in the beginning. And there's a reason for that. It's because whole life insurance is spreading out. It's taking out all the costs, or it's taking all the costs throughout the life of the policy and spreading them out through the life of the policy, making them level. So it's kind of think of it like taking some of the costs on the back end and putting them on the front end to make it level. This is really, really good because if you think about it, life insurance is supposed to be more expensive in the beginning. Cheaper in the beginning because you're young, healthy, hopefully, and your chances of passing away are very low, right? Whereas life insurance is supposed to get far more expensive as you get older because the risk of you passing away increases, obviously, right? So whole life insurance is very beneficial in that way that it levels out the cost of insurance, because when we need it the most, the cost stays the same. And in fact, you can pay off a whole life insurance policy so that you never have to make another premium payment ever again. Premium is never due ever again. We'll get to that in a minute. But that's how cost of insurance works in whole life insurance. Really important to understand that. Versus indexed universal life insurance, it's the scenario I just described where it's cheaper in the beginning. It's supposed to be cheaper in the beginning, but it's a lot more expensive on the back end. And that's because indexed universal life is built on what's called annual renewable term. Think of it like your 10, 20, 30-year term policy but it renews every single year, right? It's kind of like a 1-year term policy, all right? And what that means is that you have increasing cost of insurance with an IUL. Your cost of insurance gets more expensive every single year. Why? Like I just explained, every year you get older, the risk of you passing away increases. Therefore, the life insurance company needs to charge more for that risk, right? That's just how life insurance works, okay? So very important to understand, because that cost of insurance just explodes when you get older, right? When you hit 60, 70, 80 years old, that cost of insurance is very, very expensive, and it can be very dangerous to your policy if it's not managed. All right. That brings me to the next part that I want to talk about when it comes to cost of insurance, and that is the term net amount at risk. All right. It's really frustrating to me when I hear IUL agents say that your cost of insurance actually goes down as you get older within an IUL. And that is not true. The amount of money that is due on your within your policy, that can go down because of net amount at risk. So basically the way it works is net amount at risk is death benefit minus cash value. Okay, whatever that number is, that's what your cost of insurance is applied to. Now, net amount at risk can be managed based on your policy performing and the flexibility of a universal life policy where you can adjust death benefit and stuff like that. So that is the reason what you like your premium in an IUL can actually go down if you manage that net amount at risk. And hopefully your policy performs as illustrated, which it probably won't, but we'll get to that in a minute as well. But guys, this is so crucial for you to understand if you are considering an indexed universal life policy, is to understand how that cost of insurance works. It goes up every single year. And in order to manage that, make sure it doesn't blow your policy up and you don't get a bill from the life insurance company when you're 80, 85 years old for thousands, maybe tens of thousands of dollars because all of your cash value is gone. Well, if you don't want that bill, you need to understand how to manage net amount at risk. Okay, so that's a separate video, but it's just important to know that terminology. It's important to ask your agent about that if you're working with somebody already, because I've seen countless stories of people who have like traditional universal life policies where they get that bill at 80, 90 years old and they lose all their money. They lose all the death benefit. There's lawsuits about it. It's just really, really sad. And there's the only difference between a traditional universal life policy and an indexed universal life policy is the interest crediting strategy. That is it. It's still built on annual renewable term, which gets more and more expensive every single year. Very important to understand. Next, let's talk about the guarantees. Guarantees versus no guarantees. Actually, I should just put guarantees here, whatever, because there are some obviously some guarantees within an IUL, but they're questionable. Okay. And here's why. So first off, let's talk about the guarantees within a dividend paying whole life insurance policy. Like I was mentioning earlier, your like, for example, your premium, your cost of insurance, that's all guaranteed to never change. It's completely level throughout the policy. Your policy is also guaranteed to grow every single year. Typically the rate is between 2 and 3/4%. That's a gross number. But and then on top of that, you would get dividends. We'll get to that in a minute. But there's really strong guarantees. Nothing can change. The life insurance company can't change anything within the contract. Everything is guaranteed, right? So you know exactly what you're getting. The only variation there would be the dividends, because they're not guaranteed, but these companies have always paid them. The dividend rate can change, all right? But the structure of the policy, the life insurance company can't change. Versus an indexed universal life insurance. And I want to say really quick, the benefit of that is, like I said, you know what you're getting, but it's that stability, that safety, that it's something, it just gives you a lot of peace of mind, right? There's not a lot of variables within the policy, right? It's just going to get that nice, safe, steady growth. It's going to be there for you when you need it the most. You can access the cash value to build wealth, all that stuff, right? Versus with an indexed universal life insurance policy, there are guarantees, but basically the guarantee is that pretty much everything in your policy will change at some point in the future, meaning that the cap rates can change, the participation rates can change, spread charges, no risk charges or rates, whatever they're called, like all these things can change, and the life insurance company has to be able to change them because of the interest crediting strategy. We'll get to that shortly here, but it's important to know that there's a lot of things that can change within your policy, and you have to ask yourself, what is going to be the long-term impact on the performance of my IUL if these things change? Well, it's really impossible to tell, other than it being bad for the most part. Now, there is a guarantee that you won't lose money in the market, right? Like you have that, because you have that guaranteed 0% floor, right? Some companies have a 1%, 2% floor, whatever, which you're giving up something else within the contract. So make sure you understand what that is. All right. There's no free lunch with life insurance, guys. When you get something, you're giving something up on the back end somewhere else. Okay. But you are guaranteed at least that 0% floor. Okay. That's good. That means I can't lose money in the market. Right. So if the market because you're not directly invested in the stock market, if the market tanks 20%, the value, your cash value is not going to tank 20% because you're not invested in the market. However, there is no guarantee that you won't lose money. See, with a whole life policy, it's guaranteed to grow every single year. You do not have that guarantee in an IUL. You might have the floor, but the risk is on you for the policy to perform. Okay, because you're relying on stock market options. We'll get to that in a second. But you can and will lose money in an IUL when you have that 0% credit for that year. Here's why: because you still have all the cost of all the fees and expenses within the policy, cost of insurance, expense charge, premium expense charges, whatever. There's different expenses and things like that within the policy. Where does that come from if your policy didn't grow? It comes from your cash value, which means your money, your cash value is going backwards, right? It's also why an IUL can't compound, is because the compounding process can stop and the value of your policy goes down because of those costs and fees. And those costs can get really, really bad. Like I mentioned, later on when you're older and that cost of insurance is insanely expensive, if you're not managing that amount of risk, that can start to blow your policy up in retirement, guys. Be very, very careful with that. Okay. Now, again, this is not to say not to do an IUL, but for me, there's too many variables that can change. Like when I'm thinking about life insurance, I want stability. I want something I can rely on. I know what to expect, right? I don't want all these variables. An example would be, let's say you had a business partner. Like, would you get into business with somebody that where you're putting up all the money, you're taking on all the risk, all right? But your business partner within that contract can change whatever they want to their benefit, but you can't. Does that sound like, would you get into that business deal? That doesn't sound very good to me. Well, that's kind of what you're doing with an index universal life policy, because the life insurance company can change whatever they need in order to manage their risk, which brings me to the next point here about the interest crediting strategy of an index universal life policy. And what we're talking about here is the next phase here, the difference between dividends and indexing. And then I want to mention a really powerful IUL alternative. So if the concept of upside potential, downside protection in the market interests you, I'm going to blow your mind here in a second, but let's talk about how these policies typically grow. All right. So dividends, it's pretty simple. I might actually, well, I wouldn't call it simple, like how dividends actually work, but just to keep it simple, I'm going to do a separate video on exactly how dividends work in a whole life insurance policy. So make sure you guys subscribe for that update. But dividends, so with the whole life insurance policy, we have a guaranteed growth rate. And then because we are buying these policies from a mutually owned life insurance company, when we buy the policy, that makes us a part owner in the company, similar to like if you were to own stock in a company, right? But this is owning a policy with a mutually owned life insurance company. So what that means is that we actually participate in the profitability and the surplus, whatever surplus there is and whatever profitability the company has, that's redistributed back to us as policyholders. This is really powerful. So you're essentially a partner with some of the most powerful, best risk management companies in the world, some of the most financially strong and stable companies in the world that have been around for over 150 years, have never missed a dividend payment. You become a partner with that company with all the benefits within this policy. I think that's really, really powerful. All right. So those dividends, while they're not guaranteed, these companies have always paid them. The companies that I have my policies with just paid one of them paid their 120th consecutive dividend. And then the other one just paid 147th consecutive dividend. So very, very consistent, right? So that's how the cash value, as well as the death benefit, because your death benefit grows as well within a whole life policy. But that's how you get the growth of the policy. You have the guaranteed growth rate and then the dividends on top of that. Okay. With an indexed universal life policy, that is not the case. You are not a partner with the company. So I hear agents talk about how, buying an IUL with these really these really financially strong companies, and they've been around forever. And while that's important when you're buying a policy to, like when it comes to the solvency of the company to make sure that they're going to pay out a death benefit and stuff like that, that's important. But usually, like when you're talking about the strength of the company, it's because you're a partner with the company. That's not the case with IUL. So it doesn't matter how profitable the company is with an IUL, because you don't partake in that profitability whatsoever. In fact, you're contributing to the profitability of the company with an IUL. All the risk is on you. The risk is of the risk for the growth of the policy is put back onto you as the policyholder, because you are relying on a stock market index and options crediting strategy. That's really how the interest crediting strategy works, called indexing. All right. You're relying on that for the performance and the growth of the policy. Okay. Not saying it's a bad thing, but that's why it's like, if you have a higher risk profile and you want to potentially get more growth than a whole life policy, which I don't really think is going to happen. I think it can happen. I don't think it happens very often. And I'm not willing to roll the dice on my financial future like that. I want something stable that's going to grow every single year, and then I can build wealth outside of it. Like, I'm not trying to build a ton of wealth with the policy itself. I want to put my money in a safe place that's going to grow, give me tax advantages. I have the death benefit, and then I can borrow against it to really build wealth, really accelerate the wealth building process, right? But with an IUL, it's not the case, right? You're injecting more risk into the wealth building process, which if you're okay with that, for that extra potential reward, by all means, go for it. Okay. But we're going to talk about the illustration later, because these things look really good on paper. But anyways, with the indexing interest crediting strategy within an IUL, it's based on a call options strategy. All right. So what's happening is, this is why they can have the 0% floors, because you're not investing directly in the market. You are buying call options on whatever index you choose. If you are going to do an IUL, I usually recommend doing the S&P 500. Don't do these proprietary volatility controlled indexes. Very, very shady stuff. I've got other videos on that. But anyways, what's happening is the company will invest in call options on the S&P 500. And if the market goes up, your cash value within your policy, you'll get a certain amount of interest credit based on that move, but based on your cap. So every IUL, I mean, they have uncapped strategies as well, but like I said, there's always give and take with these things, guys. But typically, you're going to have a cap, 10%, 12%, whatever. They usually start you off at a really good cap rate and then lower it a couple years later to manage their risk. Yet they're still selling new IUL policies at the original 12% cap rate or whatever. It's kind of shady. But if the market goes up, you get up to your cap rate. Okay. If the market goes down, then the options just expire worthless, and you have your 0% or 1% floor, whatever. Okay. Now, here's the thing: is within that call options strategy, there is a call options budget, and the cost of call options that fluctuate constantly, that will have a long-term impact on the performance of the policy. As options get more expensive because of volatility, supply and demand, right? There's more demands because IULs are really popular right now, whatever, right? The cost of those options are going to go up, which is going to limit how much you're able to earn within the policy, because the life insurance company has to compensate for those additional costs. They do that by pulling the different levers within the IUL policy to manage their risk, guys. It's really important to understand. I mean, if I've lost you at this point, maybe that's a good thing, because these are these are far more complicated than what they're made out to be. It's not as simple as upside potential, downside protection in the market. You have to understand where that promise comes from, and if it's actually worth it. Like, is this actually going to work in reality? I'm not rolling the dice, but that's essentially how the IUL grows, right? With indexing, right? So they're buying call options on an S&P 500. If it goes up, you get up to your cap rate. If it goes down, you get your 0% floor, okay, or 1%, whatever. Now, the IUL Alternative, I've done videos on this. I will link it down below, where I go into all the details about how this works, guys. But I'm just going to ask you a question here really quick. If you could get upside potential, downside protection like the IUL promises, but you could get that in a whole life policy without all the levers being pulled. There are some levers, but it doesn't put your policy at risk. It's still guaranteed to grow. You still have a lot of the guarantees of whole life. So just not having the same issues with IUL. If you could get that, is that something that you'd be interested in? Well, that exists. It's not very common. There's not a ton of options for it, but there are a couple of companies that actually will use your dividend that you would have received, and you can allocate a portion of it or all of that dividend to this indexing strategy. And if the market goes up, you'll get to, you can double your dividend potentially. If the market goes down, you would lose your dividend, right? So you're still injecting risk into the policy, into the wealth building process. So I'm still not a fan of it, but there is a lot less risk with it because, again, you're still guaranteed to grow within the policy. You're not going to go backwards because of it. You're just utilizing the dividend that you would have normally received to do the call option strategy. So much safer way to do it, in my opinion. If you want to learn more about that, I'll have my training down below. Okay. So yeah, good stuff. Really, really powerful IUL alternative. So that's how the policies grow. We already talked about being a part owner of the company versus contributing to the profitability of the company and you taking on the risk. All right. Which if you're okay with, go for it. That's fine. Just know the difference. That's all. That's what's most important. Okay. I want to talk about this next. The paying off a whole life policy versus what's called vanishing premiums within an IUL. This really frustrates me. I saw this on a podcast, an interview the other day where this IUL agent was saying that you can pay off an IUL. It is just egregious. That is a straight up lie. Just because you don't see premiums being paid or the premiums stop on an IUL illustration, that does not mean you never owe another premium payment ever again. Guys, what did I say in the beginning? An IUL is built on annual renewable term. There's premium due every single year. That doesn't go away. All right. You cannot pay off an IUL like you can a whole life insurance policy. So when you see like on an illustration with a whole life policy, the premiums are gone. That's because you've literally paid off the policy. You will never owe another premium payment ever again, and your policy will still continue to grow. It's kind of like paying off the mortgage on your house. When you pay off the mortgage, you still own the house, right? It can still go up in value, right? It's literally the same thing with dividend paying whole life insurance, all right? You can pay that off. You want to pay into it for 10 years, 20 years, to your 65, to your 70. It's totally up to you. So there actually is a lot more flexibility with a whole life policy than a lot of people will say. We'll get to that later. All right. But that's actually like, I love that feature of whole life that you can pay it off. That again, it goes back to that peace of mind that I have this asset that I've paid off. It's going to continue to grow and be there for me when I need it for the rest of my life. Like I love that. With IUL, it's the exact opposite. Do not be fooled by these illustrations when they show no more premiums being paid in, that it's paid off. It is not. It's called vanishing premiums. That's the specific term that I've seen for it. Okay. Just understand, right? Again, it's not necessarily a deal breaker, but like run away from an agent that tells you, oh, look, you never have to make a premium payment ever again. Okay. Well, that's making a lot of assumptions because that cost of insurance is due for the rest of your life, guys, and it's going to grow exponentially. So you better make sure you're managing that net amount of risk so that you don't have to make another premium payment. But if your policy does not perform and you're not paying attention to it and it wasn't set up correctly, that's a big part of this as well, is designing the IUL. If you didn't fund it properly and you get older and you don't have enough cash value to cover the cost of insurance in the policy anymore, you will get a bill from the company saying, hey, either pay us this amount to keep your policy in force, or the policy is going to lapse and you lose everything and potentially have a massive tax problem as well if you've been taking income from it. Okay. So, and that will happen every single year after that. All right. Where you now have to make massive premium payments into the policy to keep it in force. To make sure you don't end up in that situation, either avoid IUL completely. Okay. Or make sure you're working with the right person and you understand how this works and how it needs to be managed, because that can be a very dangerous situation. All right, next, let's talk about some policy loan differences. All right, this is important. This is where there's actually, I would say, a little bit more flexibility with this within IUL for retirement income, not for the infinite banking concept. Guys, just don't try to do infinite banking with IUL. Oh my gosh, it's not designed for infinite banking. Okay, I've done an entire video on this as well. All right, infinite banking is where you set these policies up. You're borrowing against the cash value to go build wealth over here, right? So we've got money working for us in multiple places. It does not work well at all with IUL. just keep that in mind. With that said, when you hit retirement, right? So one of the big promises of IUL is that all of this tax-free retirement income that you're going to get. Okay. Well, assuming that your policy performs and you've done things correctly, let's say you get to that point where you're hitting retirement, you're ready to start taking income from it. All right. The problem is most agents, most illustrations I've seen show the participating loan for the retirement income, not the wash loan. So there's two primary types of loans with an IUL. There might be others, but these are the two main ones. It's participating and wash loans. All right, let's cover wash loans first because they're pretty simple. Indexing is a little bit more complicated. It's not complicated, but there's more involved. With wash loans, there's no risk of that loan, the interest compounding against you. So it's a lot safer. It's a much safer way to take income and just take money from the policy. All right. Because basically what's going to happen is the life insurance company will charge you a certain amount of interest, maybe 3%, whatever, but then it's going to immediately credit you 3% interest. So it's a wash, right? So your interest is not compounding against you. That's a much safer way to do it. The problem is most agents don't illustrate that because it doesn't look anywhere near as good on paper, which brings me to the participating loan. There's a lot of problems with the participating loan inside of an IUL for tax-free retirement income. And also, actually, one other thing I want to say about the wash loan, the reason you can't use that for infinite banking is because I've heard people say that you can do infinite banking by taking the wash loan, but you can't do that, or it defeats the purpose of infinite banking anyways. Because here's the thing is, because it's a wash loan, that means the money that you're borrowing is no longer earning interest. All right. So if you have a big year in your IUL, but you have this wash loan taken out, the amount of money you have for the wash loan does not participate in that interest growth. All right. So it interrupts the growth of the policy. That's not infinite banking. All right. So that's another part of the wash loan that you want to be aware of versus participating. All right. So basically what that means is all the money that you borrow from within when you're using participating loans, it's still going to earn interest within the policy. All right. If your IUL grows. Okay. So that can be a benefit. The downside to that is that you are accruing interest. And if you're not paying that policy loan down, that interest is going to compound against you. Now, this is really important, guys. I'm kind of jumping ahead a little bit because I want to talk specifically about the illustrations here. But since we're on the topic of the loans, when you see on an IUL illustration, when it's showing you taking out income, all right, a lot of the times it shows the participating loan and it shows the policy growing every single year as if you never have a down year, which is never, ever, ever going to happen. And it also has 50 basis points of positive arbitrage within that loan. So it's kind of like when you take the loan, you're making money, you're like above and beyond what you're paying in interest. So the policy is going to continue to grow every single year. Never going to happen. Market doesn't go up every single year, guys. So that's very dangerous because that interest is going to compound against you. Okay. So let's say you're 5, 6, 7 years into taking money from the policy. Let's say you've been taking $50,000 per year and you now have 5, 7 years later, you have a $250,000, $350,000 loan balance at 5% interest. Actually, it'd be more than that because the interest is compounding against you. But if you have a 0 year, which is going to happen, where does the interest cost come from on a $300,000 loan? Where does that interest come from if you get a 0 year? It comes from your cash value, guys. That's why the illustrations with these things can be so incredibly misleading. You have to be so careful who you work with. I've only seen and spoken to a couple of agents that do it the right way. They put zeros in to make it more realistic. They show withdrawal up to basis and then wash loans. Like that is how you're supposed to do it, but it doesn't look anywhere near as good on paper. So a lot of people probably wouldn't do it if they showed the wash loan and doing that strategy. So just be very, very careful with the participating loan, guys. That's typically what's illustrated at the end of the policy when you're taking retirement income because it looks really good on paper, but that interest is compounding against you. When you get a 0 year, that can be devastating to your policy depending on what year you're at and how much you've taken. All right, policy loans with whole life insurance. It's pretty simple. I mean, it's just you're taking a policy loan. That interest will compound against you if you are not paying that policy loan back. But typically, we're doing that with the infinite banking strategy, where you're going to be paying the loan back. That's why if you're not disciplined with money, infinite banking is absolutely not for you. But typically, you're going to be paying that policy loan back, so it's not an issue until you get to retirement. So if you're going to use your policy for retirement income, again, I'm not a fan of stacking really big loans and like aggressively taking income from the policy, guys. Just be very careful with that because that interest is going to compound against you. Now, the difference is that a whole life policy is guaranteed to grow every single year. You're not going to get that 0 year that would be just devastating to your policy. And also, if you fund your whole life policy properly, you let it grow for long enough, it's pretty efficient. Whole life policies get more and more efficient every single year. Then it's not as big of a problem, but you have to make sure you're not over leveraging the policy and taking too much income via a policy loan, because that can get out of control if you take too much. But again, as long as you're working with the right agent, they illustrate it very, very conservatively. They illustrate it as a supplemental tax-free retirement income, then you should be okay. And I want to stress the supplemental part of that phrase, because I particularly see this with IUL, where IUL is supposed to be it's supposed to become the primary source of retirement income. I see a lot of agents talking about replacing your 401k with it. Like that is just insanity. Don't even know how that's legal. But anyways, it becomes the primary source of retirement income. It was never meant to be that, guys. All right. It just doesn't work for that. It's a supplemental retirement source of income. It can make your other assets perform even better and last longer in retirement, because they can be a volatility buffer as well. There's just like so many benefits to having whole life insurance or permanent life insurance in retirement. But it's just important to understand the differences here. Okay, this is supplemental retirement income. So with that said, what you could also do, what I'm a bigger fan of when using whole life insurance for retirement income, is don't do the policy loans, at least until you have to. You can do a withdrawal up to your basis, which means all that's tax-free until you reach however much you put in. Okay. You could also turn your dividend into paid in cash. And is that going to be a ton of money? Is it going to look as good on paper as it does in IUL? No. But if we're being realistic about this and acknowledging that this is just a supplemental retirement income stream, and I could take more if I needed to during a down year in the market where my portfolio just took a big hit. Maybe I don't want to take money from my portfolio for the next couple of years. I'm going to give the market time to recover. So I'm going to take a little bit more from my whole life policy, while it recovers, and then resume taking money from my portfolio. To me, that's how it's really supposed to be done. So just a couple of different things to think about. But as far as the policy loan with a whole life policy, it's pretty standard. You're going to, you borrow from your policy based on how much cash value you have. And then there's going to be a certain interest rate on it. And if you don't pay that policy loan back, it will compound against you. Otherwise, it's simple interest. It can be really, really powerful. I've done other videos on that, but those are the main differences. Hopefully that helps. All right, let's talk about policy flexibility. So a lot of people are under the assumption that whole life is not flexible at all, and IUL is way more flexible. And while IUL does have more flexibility as far as like premium payments and death benefit and all this stuff that you can change at your leisure, I don't know that that's a good thing. I suppose when it comes to managing net amount of risk, you have to have that. But if I have to reduce my death benefit to stop the policy from potentially lapsing or getting into trouble or whatever, I don't like that framework to begin with. I don't like that foundation whatsoever. The fact that I might have to do that. So I'm not a fan of that. That flexibility. That flexibility can actually hurt you if you're not careful with it. Meaning, if you have the flexibility to lower how much money you're putting into the policy, are you asking yourself, or have you asked your agent what that's going to do to your policy long term? How is that going to fit into this illustration that you're showing me? How is it going to change that? Well, it can change it drastically, guys. If you don't, like, you could design a policy, an IUL perfectly, but if you don't fund that thing properly the way it was supposed to, none of it matters. That thing is going to likely blow up in your face later on down the road, or at the very least, it's not going to do anywhere close to what was illustrated. All right. And that's a big part on the policyholder, right? But it's just important to know that that flexibility can actually work against you. All right. So IULs have more flexibility with regards to that, but whole life policies have a lot of flexibility as well. So number one, like I said, you could pay them off. I think that offers a lot of flexibility because you can choose how long you actually want to pay into it versus with an IUL, you can choose to stop making premium payments, but that doesn't mean the premium payments not due. Okay. Very important to know the distinction. But the other flexibility within a whole life policy is that you can design it based on your specific goals and situations as far as how much you want to put into it, how much base premium you want to pay, how much paid up additions you want to pay. Because here's the thing, the base premium in a whole life policy is the bill that you get every single year. It's the minimum amount that you need to pay until the policy's paid off, which you decide in the beginning or later. You could do it later too. But the base premium is what you're on the hook for every single year. The paid up additions, though, that is completely at your discretion. All right. So, for example, in my policy, my first policy, I set it up to do $25,000 per year. Well, 25% of that is base premium. I think it came out to about $6,000. Yeah, it's like 6,200, I think. So that's what I'm on the hook for every year. Versus the rest of that 25,000, it's like 75% is paid up additions. All right, which is those are not required at all. So I have the ability. So I have a minimum that I need to pay of 62, like around 6,200, but I can put up. I have the flexibility to put up to 25,000 if I want, which I absolutely want because I want to put as much into these policies as I can. All right. But let's say 1 year, I'm struggling, cash flow is tight, and I don't have the 25,000 put in, but maybe I have 10,000 or 15,000, right? Obviously, that's going to have a negative impact on the long-term performance of what was originally illustrated, but it's still good. It's still growing. I'm still putting money into it, or I could skip it all together. All right. And there's also catch-up payments that you can make as well. Every company is a little bit different with that, but there is actually a lot of flexibility within a whole life policy. So really important to understand. And again, that comes down to making sure you work with the right person, preferably somebody who already does this. So last thing that I want to talk about, and then we'll wrap this up. Illustrations look really good, particularly with IUL. So here's the thing, guys. Before I start with IUL, illustrations are just meant to give us an idea of what could possibly happen. It is not a guarantee of what will happen. And you really shouldn't be purchasing either a whole life or an IUL just based solely on the illustration, because it's just an idea of what could happen. Now, here's the thing. It's much more likely that what you see in a whole life illustration is going to happen versus an IUL. There's so many things wrong with an IUL illustration, particularly the way that people do it. Most agents, again, I've worked with agents that have very, very much more conservative IUL illustrations that I think that's how it should be done. If you want to see that, I'll link that down below. I've actually done a video on that. But the majority of IULs illustrations are just fantasy land, guys. It's so overhyped. Even when they say it's conservative, it's not. So, but to finish up with the whole life policy, the reason, or the whole life illustration, the reason that a whole life illustration is far more likely to actually happen than IUL is because we're not relying on the stock, like any stock market index for the growth of our policy. We're not relying, we don't need to worry about, what's going to happen with the options budget, which is generated from created from the general fund, the performance of the general fund from the life insurance company. We don't need to worry about the cost of call options and stuff like that. Like none of that matters at all. It's all about the profitability of the company. These companies have always been profitable. They've never missed a dividend payment through the Great Depression, both world wars, savings and loan crisis, the dot-com bubble, 2008 crisis, pandemic. They've always paid a dividend, right? So that's why, so you have the guaranteed growth rate, you have a dividend that's always been paid. That's why when you look at a whole life illustration, almost said IUL there, With a whole life illustration, it's much more likely to actually happen because it's based on the long-term performance of this company, the long-term profitability of the company and their ability to pay dividends. And you can even control the dividend scale on an illustration, which I actually just did for someone I'm working with right now. I actually lowered the dividend scale on the illustration to make it a little bit more conservative because dividends are actually going up, which is great for me. My dividend's gone up twice now for my first company. But just went up for my second, the company I set my second policy up with. I'm really happy. My policies are already outperforming, right? Because dividends have been at historic lows, and it's still a really good time to set them up. But I can actually lower that dividend scale. So if the dividend right now is 5.75%, which is what the for this company, which is what the illustration is based on, is the non-guaranteed side where the dividends are paid. It's based on the current dividend rate. All right. It's not based on potential stock market performance like an IUL. Okay. Which that's misleading as well. We'll get to that. But it's with this whole life illustration, you can lower the dividend scale to it's not an exact amount, but I could do 90% of the current dividend rate. That way, if dividend rates come back down, we're not super disappointed. Like, hey, why isn't my policy performing like it shows on this illustration? Well, we need to manage expectations here, right? So whole life illustrations, way more realistic, way more likely to at least get close to what's being shown versus an IUL. Oh man, how many problems there are with an IUL illustration. All right, so the big red flag that I noticed when I really started looking at these things is that it shows growth every single year. Guys, when have you ever known the stock market to go up every single year? It doesn't happen. And there's a very, very, very big difference between average rate of return and actual rate of return. I've done a video on that too. Okay. But here's the thing is when you see that 6.42% every single year, all right, and they call that, oh, well, that's just the average of what you're going to do. No, it's not. Not even remotely close. And there's so many reasons for that. I'll touch on a few of them here really quick. Maybe I'll do an entire video just on an IUL illustration. But here's the thing is first off, you have the cap. And that cap is likely going to go down at some point. So you might start at 12%, then maybe have 11, then maybe have 10, right? And what does that do to the average, your ability to get anywhere close to an average of 6.42%? If you're capped at 10, it's almost mathematically impossible to do, all right? Because the market is down like a third of the time, I think. So you're going to have a lot of zeros within, or at least not, you're going to have a lot of years where you don't hit your cap. That's going to have a very negative impact on getting close to the average rate of return there. Not going to happen. Okay. That's number one. Number two, you don't even participate in the full upside of the market. And I'm not talking about the cap. I'm talking about the full performance of the market because you're not invested directly in the market. You don't participate in dividends and you have extra cost associated with tracking the performance of the stock market because you have call options involved. What did I say earlier, guys? There's a cost of call options, which fluctuates all the time. And then you have the call options budget, which is based on the performance of the general fund of the life insurance company. Interest rates can impact that. Interest rates have a massive impact on that. So all these things are changing. How can you even use the S&P 500 to get an idea of what your IUL policy will actually do? Because there's so many variables here, so many things you don't actually even participate in. So it's not to say to not do an IUL. It's just to be a lot more realistic about what to expect from the IUL. And that's why like who you work with is so important when it comes to IUL. Because like when you guys watch the video I did with the gentleman on my channel where he broke down how he typically structures an illustration for IUL where he's actually inserting zeros every fifth year, right? He actually lowers it from 6.42%, I think, to like 5.5%, whatever. All right, so still there's like to me that's a lot more realistic. I still would not buy the IUL. There wasn't enough potential further upside over my whole life policy. Which I think is actually going to come pretty close to outperforming IULs long run. Anyways, you just got to be really careful with these illustrations because they're very misleading. All right. It shows growth every single year. That's not going to happen. It shows those vanishing premiums, like I mentioned earlier, where it like you think it's paid off and you never have to make a premium payment ever again. Not going to happen. That's not true. You do owe a premium. You have a premium payment for the rest of the policy. We already talked about the retirement income with the participating loans and stuff. It's just like, man, there's a lot of red flags here. You know, is this something that we really want to roll the dice with on our financial future? Not me. Like, here's the thing. For me, the potential additional upside over the whole life policy was not worth it. All right. Now, if it's worth it to you, fine. As long as you understand how you need to manage this thing and all the things that can change. Okay. You need to make sure you're working with the right person. If you still want to do an IUL, fine. I don't have a problem with that. I have a problem with the misleading nature of IUL. Okay. All the things I can change. And it's not worth that extra potential 1, maybe 2 percentage points of growth over the long run over a whole life policy. It's just not worth it to me. The risk is not worth it. So anyways, I'll go ahead and wrap up with that, guys. I told you it was going to be a longer video. Hopefully that's okay. I'll timestamp everything as well, just to make it easier for you guys. But I hope that helped. If you have any questions, drop them down in the comment section below. Also leave some feedback as well. I know I'm probably going to get some interesting stuff about this, but I'm always open to having a good conversation with people that disagree. That's totally fine. That brings a lot of clarity. So anyways, I hope you guys are crushing it. Make sure you check out the links in the description. I have plenty of additional tools, training resources in there that you can take advantage of. And I will talk to you in the next one. To your success, Matty Ice is out.